Hello and welcome to today's podcast. We're live streaming on LinkedIn. I'm joined today by Stephen King of Growth Force, and we are going to talk all about sustainable giving. Stephen, welcome. It's so good to have you as part of this conversation. I've enjoyed working with Growth Force so much in the past. You guys do great work.
Thanks, Katie. It's great to be here.
Yeah. Well, tell us a little bit about yourself, your background, and the work of your organization.
So, Growth Force, we're an outsourced accounting department for nonprofits that use QuickBooks. And what we do is we focus on helping them run better, grow faster, and raise more money. So, we're not your traditional accounting department. We take care of all the compliance and we do the payroll and the tax filings with their CPA, and we help make sure the board reports are ready. We teach the executive directors and the leadership team how to read and interpret those reports so that they can answer the questions from the finance committee. But I like to take it one step further than the very valuable and important role of the accounting department, and that is to help the accounting department be a resource for the development office. I got a really unique opportunity at age 29. I left Ernst & Young after 7 years, and I got to become the chief financial officer of a $20 million nonprofit called Amnesty International USA. And so
Very
I was,
familiar. Wonderful
yeah,
organization.
it was great. I was a volunteer there for 3 years before I joined as the CFO. I was the deputy executive director for finance and administration, which basically meant I was responsible for anything that was not human rights related.
Hmm.
And so that included fundraising. And after working there for 4 years, we put it, I came in 2 weeks after Bruce Springsteen, U2, Sting, Peter Gabriel, and a whole bunch of other friends finished the worldwide Human Rights Now tour. And that was back in the day of Live Aid. We went from 6 million to $18 million in revenue in a year and a half.
Oh my goodness. And I don't
Yeah.
want to date myself, but I remember those concerts. Yeah.
Oh, MTV, it was a game changer, right? And so my job was to come in and do what I did at Ernst & Young, which was put in the infrastructure, put in new accounting systems, HR systems, and IT upgrades. And when I had finished that after 4 years, I went to the executive director, Jack Healy, who was my boss, and said, I am ready to become the executive director. I'm 33 years old now, and I'm ready to be the boss somewhere. And I wanted your advice. And he said, well, you better learn how to raise money because the job of the executive director is to raise money. And I thought, okay, I'm an accountant, right? I'm not sure how to do that. So maybe I should change my career goals. 2 weeks later, the director of development, Dier Tikel, quit. She came in and she said, Dianne Feinstein's decided to run for Senate. That tells you how many years ago that was. And she needs me, so I'm leaving. She was her campaign chief fundraiser. So Jack said, take over fundraising. And I learned how to be director of development. I did that for 3 more years. And I realized your numbers have to tell a story. You have to go to the donor and be able to show them the tangible result of their gift. And so ever since then, I've dedicated my life to helping do that.
That is a beautiful cause. And I'm thinking about all my fellow executive directors. I doubt many of us think of our accounting duties in terms of telling a story. I think
Mm-hmm.
most of us probably cringe or break a sweat when we think about accounting. So what you do is important and needed.
Yeah, and the truth is that most accountants never think about the development office as a stakeholder. And when it comes time for writing a foundation grant or going to a personal donor for a solicitation, you're you're often going to an accountant who doesn't have an accounting degree, right? Because most nonprofits can't afford somebody with $125,000 salary, and whose job description wasn't designed for the development office. So the systems aren't set up to just hit a button and be able to give development what it needs. It takes a lot of work to manually figure out how much overhead gets assigned to each program and whether or not the actual grant that we got last year was spent. All the tracking and the compliance and the the reports on the outcomes are critical. but that's not what accountants are trained to do. So I think that's what makes us special.
Absolutely. Absolutely. Well, today we're going to talk about sustainable giving. And one of the things I want to kick off with is something that always surprises me, and that is how tiny of a piece corporate giving is in the nonprofit world. I think Giving Tuesday, the latest report, which is 2020, has it at 4% of fundraising for nonprofits. And every time that report comes out and I see it, I'm always shocked, but I don't know why, because the number doesn't move a great deal.
Right.
Why do you think nonprofits think corporate giving is such a solution? And why isn't it? Why is it not maybe the best place to focus our efforts?
Well, the Giving USA report speaks to how 80% of the money comes from individuals, either through personal solicitation or planned giving. And the the I think the reason foundations and corporations are seen as the saving grace is because it's often looked at as easier. There is a schedule that the foundation has, and there's a mission statement that they publish, and they identify who they want to give to, and when they're going to make decisions, and what the requirements are, and how you need to submit the information. And it's a formula it's it's hard to get foundations to give you money, but it's relatively easy because you can look at it and say, okay, here are 12 foundations that give to our cause, and let's just put it on a schedule and let's make sure that we're doing this every quarter. Whereas for individuals, there is no schedule. There is no mission statement to follow. There is no calendar that you can go to and say, okay, I know you and your spouse are going to sit down and make decisions on November 28th. So let's meet on October 15th, because that's just not how it works. But all of the statistics show that if you want to increase your giving, the best way to do this is to build a case statement and go to your existing donors and ask them to give more. And I'm happy to dig into how to do that if you like.
One more thing I want to touch on, so kind of related to corporate giving and maybe even corporate foundation giving. Do you feel like part of the miss is that that kind of giving is event based? I mean, typically it's like you said, running on a cycle. It's often tied to sponsorship, but with a person, rather than being tied to an event, it's usually tied to heartstrings,
Mm-hmm.
to a motivation that is tied to your cause.
I think that's exactly it. I think that the thing that surprised me the most, and Katie, you're right. These numbers have not changed since the 90s, right? We're talking 3 decades, and it's still 80. It went down from about 82% to just under 80% last year. But the amount of money that gets raised from corporations, foundations, and events is the lowest ROI. And one of the things that's really important, one thing that I can say with great confidence to every single listener out there is that your single biggest expense is your people. There's no other expense that even comes close. It's like a service business, right? We specialize in.
Oh, looks like we lost you. We're going to jump off the live stream. We will get Stephen back, and I encourage you to check out the full episode when it comes out this Friday, March 4th.